Today is Wednesday, July 13th, National French Fry Day. Today I want to take a look at two stocks, a winner and a loser, based on the analysis I did, just to see if we can learn anything from it, and I think we can. Starting here with Crocs, shoemaker, if you want to call them shoes. Anyway, what I see here, or what I did see here at the point of the arrow, let's move that a little bit. Actually, it's fine. At the point of the arrow, right in there on that day here, what I saw here was a stock that had broken out of a range and pulled back to test that range. It was above its major moving averages, the 200-day, the 50-day. It had rising on-balance volume, outperforming the market over the last couple of weeks. So it looked pretty good. I liked it on the pullback. I thought that it would be a pretty good low-risk entry to buy above this level at the breakout. And sure enough, that worked out to be quite nice. It goes from 10 and change to 12 and change in a few days, and that was pretty good. So what can we learn from that? Well, this is a pull the trigger type of lesson. The setup was there. Take it. And now let's take a look at one that didn't work out quite so well. Here is Capital One Financial, a bank. And at the point of the arrow, let's fix that a little bit. At the point of the arrow is where I saw this stock. And I looked at a few things, and it looked weak. Trend in on-balance volume, trend in price were down, banks were generally out of favor. Yield curves getting flatter, which doesn't help banks. Definitely underperforming the market over a long span. And here it was in a declining trend channel below its major moving averages and sitting at support. Now, why did I draw the support there? I'm going to get to that in a minute. So I was looking to sell the stock as it took out that low. So I was looking at it the next day. I wanted to sell that stock if it took out the low here, which was, to me, a support level. And now let's change the chart to a weekly. And now you can see why I thought that was an important level. First, let me get rid of some of these markings, which we don't need. Okay, so this is the bull market from 2009. You can see a nice trend line, broke into the downside and tested successfully, and down it goes to establish a new declining trend. So here was a support level. Now, why there and not a little bit lower? Well, here are the Fibonacci retracement levels of that bull market. And it's right there at the 38.2% level. That's why I thought that would be a great place to sell it. It was low risk. And if it went down below that and came back up, stop out point would be pretty quick, minimal loss. I thought the downside was to the bottom of the channel. Well, what happened was that it never actually took out that low. So no harm, no foul. It wasn't triggered. Didn't actually lose money there, but it was a bad interpretation of what was going on. So what do we learn here? Well, you take your setup anyway, but you set a good level and you wait for your trigger to actually happen. All right, so there you have it. We have one analysis that worked out well, one that didn't, although because of a technical discipline, if you will, it didn't really cost anything.